Short selling is a trading strategy where an investor borrows a certain asset, sells it in the market with the expectation that the price will decline, and later buys it back at a lower price to return it to the lender. This investment strategy is used to make money or hedge against risk during market downturns. To engage in short selling, an investor needs to work with a brokerage firm. The brokerage firm facilitates the borrowing of a specific asset by the investor and allows them to sell it. During this process, the investor pays a certain interest rate to the brokerage firm. Subsequently, the investor sells the asset in the market with the expectation of a price decline and buys it back at a lower price when the price drops. After buying back the asset, the investor returns it to the lender, and the difference between the selling price and the buying price becomes the investor's profit. Short selling is a highly risky strategy as the investor can incur significant losses if the markets rise. Therefore, it is recommended for investors to engage in short selling only when they have an expectation of market decline. What risks does an increase in short selling pose to the markets, and how can these risks be minimized? How did the regulations and reforms implemented after the 2008 crisis impact the global economy? To what extent did the collapse of Lehman Brothers contribute to the spread of the financial crisis? For all this and more, before starting the video, if you're interested in universal economic history, you can subscribe to my channel and turn on notifications to be informed about new videos I upload every day. Enjoy the watch.
Universal economic history.
The 2008 financial crisis was a major crisis that deeply affected the global economy. The key causes of this crisis are as follows. Mortgage crisis. One of the main causes of the crisis was the mortgage crisis in the United States. This crisis started with the burst of the housing bubble in the real estate market. People purchased homes with loans they couldn't afford to repay, and these loans were later transformed into high-risk securities. As the value of these securities declined, the mortgage market experienced a significant collapse. Weaknesses in the banking system. Another cause of the crisis was weaknesses in the banking system. Banks pursued large profits by granting numerous risky loans. However, when the debts couldn't be repaid, these banks faced difficulties. Many major banks went bankrupt, leading to a major crisis in the global financial system. Deregulation. Deregulation of the financial sector in the United States is another significant cause of the crisis. The loosening of regulations allowed banks to take on more risks and hold less capital. This further contributed to the escalation of the crisis. Global debt burden. The global debt burden in the global economy was also one of the key causes of the crisis. Both households and companies accumulated significant debt to finance their consumption. However, when these debts couldn't be repaid, it led to market collapses. The stock market crash, which deeply affected the global economy in 2008, was the result of a major financial crisis. At the center of this crisis was the collapse of Lehman Brothers, an investment bank based in the United States. The collapse of Lehman Brothers triggered the collapse of the global financial system and had a profound impact on the world economy. So, what was behind the collapse of Lehman Brothers? Lehman Brothers, founded in 1850, was one of the largest investment banks in the United States. However, by 2008, the bank had started to engage in high-risk mortgage lending. As the housing market bubble burst, Lehman Brothers' portfolio also began to decline in value. To cover these losses, the bank had to borrow more. However, the bank's situation continued to deteriorate, and the U.S. government refused to bail out the bank. The government's announcement triggered the bank's bankruptcy and shook the global financial system. The mortgage crisis and subprime loans played a significant role in the 2008 financial crisis, which is considered one of its key causes. So, how did this crisis unfold, and what was the role of subprime loans? Mortgage loans are debts provided to individuals who want to buy homes. These loans are typically long-term and are given to cover a portion of a home's value. However, in the early 2000s, a housing bubble formed in the U.S. mortgage market. Banks started to relax their credit standards to issue more mortgage loans. This led to more people buying homes and drove up housing prices. However, when this bubble burst, many people became unable to make their mortgage payments and lost their homes. This situation worsened, particularly in cases where subprime loans, high-risk loans, played a significant role. Subprime loans are high-risk loans given to individuals with poor credit histories. When these individuals struggled to make mortgage payments, banks experienced significant losses. Spread of the crisis. Effects on the global economy from the U.S. to the world. The 2008 financial crisis initially affected the mortgage market and banking sector in the United States. However, the crisis quickly spread to other countries and led to a global economic crisis. So, how did the spread of the crisis occur, and what were its effects on the global economy? The spread of the crisis began with the bankruptcy or substantial losses of major banks in the United States. The collapse of large banks like Lehman Brothers caused a significant market crash. Stock market declines and panic spread, affecting the global economy. European Union countries were among the most affected by the mortgage crisis in the United States. European banks had invested in the U.S. mortgage market, and when the value of these investments declined, they suffered significant losses. The crisis also affected countries like Spain, Italy, and Greece in Europe, leading to economic collapses in these countries. During the 2008 financial crisis, central banks worldwide took action and implemented various policies. The primary objective of these policies was to minimize the effects of the crisis and support economic growth. Here are some examples of central banks' response and implemented policies. Interest rate cuts. Central banks lowered interest rates to provide cheaper sources of funding to banks. This allowed banks to lower their borrowing costs and reduce interest rates on loans, which stimulated consumer spending. Increase in money supply. Central banks increased the money supply to support economic growth. This increased liquidity in the markets, enabling banks to provide more credit, and contributed to higher liquidity in the markets. Asset purchase programs. Central banks launched asset purchase programs to stimulate the economy. These programs aimed to improve banks' balance sheets and increase market confidence by purchasing troubled assets. After the 2008 financial crisis, governments, central banks, and regulatory agencies worldwide initiated various reforms and regulatory efforts to make the financial system more robust and reliable. Here are some examples of regulation and reform efforts after the crisis. Dodd-Frank Wall Street Reform and Consumer Protection Act. This law, passed by the U.S. Congress in 2010, aimed to strengthen regulations in the financial sector and make the financial system more resilient. The law introduced several new requirements, such as increased capital adequacy and stricter oversight for banks. Basel III. This regulation package, developed by the International Banking Authority, introduced increased capital adequacy requirements for banks. This aimed to better prepare banks for financial shocks and enhance risk management. G20 reforms. After the 2008 financial crisis, leaders from the world's largest 20 economies, G20, gathered and signed agreements on financial sector reforms. These reforms included increased bank capital requirements, tighter bank supervision, and improved management of financial risks. After the 2008 global financial crisis, numerous changes occurred in the stock market and the economy. Many financial institutions went bankrupt, stock prices and other asset prices declined, and panic spread throughout the markets. However, gradually, the world economy and stock markets began to recover. Many countries expanded their monetary policies to stimulate economic growth after the crisis. Central banks kept interest rates low to stimulate the economy. Additionally, many countries introduced new regulations and reforms to tighten control over the banking sector and ensure financial stability. However, in recent years, stock markets have experienced increased volatility due to factors such as uncertainty in the global economy and technological developments. Technological advancements, including high-frequency trading, algorithmic trading, and other innovations, have made markets faster and more complex. The entry of new companies into stock markets has also influenced the dynamics. However, stock market fluctuations, volatility in equity markets, unemployment rates, global economic growth, and other factors will continue to impact the markets. In conclusion, significant changes have occurred in the stock market and the economy since the 2008 crisis. The global economy and stock markets gradually recovered, but uncertainty and volatility persist. Technological advancements have made markets faster and more complex, while new regulations and reforms aim to enhance stability. Stock market fluctuations will continue to be influenced by factors such as market sentiment, economic indicators, and global events. Thank you for watching my video. If you liked it, please hit the like button. If there's a specific video you'd like me to make on economic history, don't forget to mention it in the comments section. I wish everyone a pleasant day.
Universal Economic History.